Excellent. Well, thank you so much to the conference organisers and for all of you here today to allow me to present a very early stage work suggestively titled How do Venture Capitalists Actually Make Decisions? Internal Evidence from Startup Accelerators. This is joint work with my colleague, Kurok Ray at Texas A&M University, and really appreciate your questions and comments throughout. And please ask questions. I don't want to talk for 45 minutes straight in silence. So please interrupt me at any time. Excellent, good. So to provide a little bit of background motivation for this study, it's a well-known fact that entrepreneurial startups are a key source of innovation in the economy and a key source of new job creation. However, starting entrepreneurial startups is an extremely risky venture, with two sort of key impediments to startup development being the lack of funding, especially for early stage ventures, as well as insufficient resources to adequately train and mentor startup founders. And so as a result, 80% plus of startups will die in the so-called startup valley of death, which ranges from when the company is initially founded through to when the company starts to generate some positive cash flows. And so to try and address this large and pervasive gap in early stage startup funding, there's been a rapid growth in so-called startup accelerators, which went from sort of only a handful in the mid-2000s to upward estimates of over 7,000 startup accelerator programs today. And so to sort of fix ideas about what these startup accelerators do, so for sort of for-profit or venture capital-backed startup accelerators, the general sort of model is that the basic sort of model for these sort of private accelerator programs is that the VC investor will provide a small upfront financial investment to the startup firm, so ranging from about $50,000 to $200,000. And then we'll also put each of its portfolio companies through a focused sort of 3-month intensive education and mentorship program that's really designed to sort of supercharge or accelerate the growth of these portfolio firms. And in return for these private accelerators, they receive some sort of ownership stake in the startup firm, typically ranging somewhere from 5 to 10% ownership stake. Now, despite their growing importance, relatively little is known how these early stage VC investors actually make portfolio firm decisions as well as negotiate financial contracts with startup firms. So most of the empirical evidence that we have today consists of comparing the ex post outcomes of startup firms that go through accelerator programs with the ex post outcomes of startups that don't go through accelerator programs. Great, and so most of the evidence that we've seen is sort of focused on just simply comparing sort of ex post sort of outcomes between the accelerator-backed companies versus those that are non-accelerator-backed companies. And so while the general consensus has been that accelerator-backed companies do significantly better relative to non-accelerator-backed companies, these types of studies are rife with sort of measurement and endogeneity issues. And so the key sort of underlying problem, there's really limited empirical research in this space, is that there's really been a lack of comprehensive data about the entire accelerator process run by venture capital-backed accelerator programs, spanning from all the way from startup application to VC startup selection, to the signed financial contracts between these VC investors and the startups, to program participation, to monitoring startup outcomes. And so as a result, there's still much that's unknown about the internal functions of these early stage VC investors and how they contract with early stage startups. And so this paper's solution is that we're going to use a confidential data set from a large accelerator program run by a prominent US VC firm that's essentially going to allow us to open the black box of VC portfolio firm selection as well as VC startup financial contracting. And so we'd love to hear your thoughts about the different questions that we can answer with this very unique data set. But the questions that we want to try and address today is how do individual VC employees evaluate startup potential? And so as I explain a little bit more detail in a second with our data, because of the richness of our data having multiple judges looking or evaluating multiple firms, we believe that our setting allows us to answer some topical questions about whether there's outright discrimination against minority-backed startups, and also whether there's any prevalence of any affinity biases between individual judges and firm founders that might affect how individual VC judges evaluate startup potential. And then second, we want to look at what are the factors that influence VC startup contract negotiations. So looking at the financial contracting instruments that these startups and VC investors are using. Are there any important sort of anchors or reference points that set key investment contracting terms? And finally, what is the specific role of startup financial constraints in affecting relative bargaining power as well as ultimate sort of financing terms obtained? Okay, so to briefly preview our results, we document a number of unknown facts about the VC's selection process as well as financial contracting. So first, we find that there's, even when evaluating the exact same startup firm, there's substantial heterogeneity amongst individual VC judges when trying to evaluate a startup's potential. And so while we don't find any evidence of any outright discrimination, what we do find is there is an element of significant judge-founder homophily biases in the sense that even when evaluating the same firm, judges who have a same shared gender, same educational background, worked for the same employer, are significantly more likely to give higher scores to firms relative to judges who evaluate the same firm who do not have these potential homophily biases. And that this tends to be concentrated in more ambiguous information settings. And then second, we also provide some of the first empirical evidence of a recent innovation in startup financial contracting known as deferred equity agreements, which seem to have largely replaced convertible notes as the early stage financing contracting vehicle of choice for startups and VC investors. And so we're also going to show that future equity pricing is closely tied to a startup's current valuation, and that financial constraints do significantly hinder startups in terms of the attractiveness of the investment terms that they obtain relative to other similar quality peers who do not have same level of financial constraints. Yes?
For the uninitiated among us, what is the distinction between deferred equity and convertible note?
Yeah, no, that's a great question. So I'll get into it a little bit later in the presentation, but essentially convertible note has a mix of both debt and equity attached to it. So for a convertible note, there tends to be like an interest rate, a specified maturity date that you can demand repayment. These deferred equity agreements don't have any debt component at all. And then I'll explain a little bit more. There's some other subtleties as well that's a little bit different between the two agreements. But when we get to it, I'll happy to delve into the details a bit more. Okay, so in terms of the confidential data set that we are fortunate enough to have access to, so our sample VC firm is a specialist investor in early stage companies through periodic 12-week accelerator programs. And so these programs are located at major US startup hubs, so for example in Texas, in New York, in California, and they've raised sort of multiple funds totaling over $100 million. And so what's really nice about this data set is that we've been given a comprehensive data set about all the company applications, all the internal VC judging scores, and all the financial contracts that this VC investor has signed with startups. And so we've got a little over sort of 8,000 applications across 10 accelerator cohorts between 2017 and 2019. And to give you a sense of how competitive it is to get into these programs, and on average about 12 startups per cohort are accepted, or about the top 1 or 2% of applicants. And so some of the key benefits of this internal VC accelerator data set is that, first of all, because we've given a complete record of all the company applications and also the judging that has gone on for each of these firms, we don't run into the same issues that some prior studies have run into, where you have selected VC disclosures about which contracts they decide to give researchers or not. Second, all the judges in our particular setting are investment professionals who specialize in evaluating startups versus compared to other studies that use like new venture competition data or use government-backed or not-for-profit accelerators. Those judges may not be investment professionals. They could be academics or PhDs, et cetera, et cetera. And then finally, because we're looking at a for-profit VC accelerator, the focus of the VC partners and employees is on investing real dollars and maximizing financial returns. Whereas we compare that to, say, new venture competitions or government-backed accelerator programs, the cash prizes might be a lot smaller, and also the evaluation criteria may not be 100% commercial. So it might be about social goals or supporting investment in the local community. Okay, so obviously, we think there's a lot of benefits associated with this confidential data set. However, a natural question to ask is related to external validity. So how can we generalize the findings that we make about this particular sample accelerator to other accelerators or other VC investors? And so we try to approach this question from two different perspectives. So the first perspective we take is, well, how do the characteristics of the startups that apply to our sample accelerator compare to the characteristics of other startups that we know have applied to other accelerator programs? And so helpfully, Emory University has compiled a database of the characteristics of startups that have applied to other accelerator programs globally. And so if you kind of compare our sample relative to these so-called global statistics, it doesn't appear as though the startups that are applying to our program are really significantly different from the population of other startups looking to get acceptance into accelerator program. So suggestive that our startup sample is broadly representative of the entire population. The second way we can kind of think about this is, how does our sample VC investor or accelerator backer compare to other investors in this space? And so in 2021, Beta Boom did a study of about 3,000 accelerators globally and looked at each of these firms in terms of their exit performance, and found that our sample accelerator was in the top 2% worldwide in terms of exit performance, with sort of an average internal rate of return in excess of 25%. So clearly, our sample VC firm has above average return performance, but we think that, if anything, any bias that we have towards a relatively successful VC-backed or startup accelerator is actually helpful, because we're more likely to identify the tendencies and methods of a relatively successful value maximizing early stage investor. Okay, so in terms of turning to our first research question about understanding the VC firm selection process, for our particular accelerator, let me very briefly try and explain how do they choose which firms to invest in. So startups will submit an application. They'll kind of get a very coarse initial screening, just looking for trying to remove sort of Bobby's lemonade stand and a bunch of other sort of basic characteristics. For those that look a little bit more promising, they'll be asked to submit a due diligence pack, which will ask more detailed questions about the business itself as well as the management team. And then once these due diligence packs come back, this VC firm's individual employees will read these applications and provide a score from 0 to 100 about how promising this particular startup looks for an investment opportunity. So of those that submit a DD pack, about a third will make it through to being invited to a first round interview. Then there's another round of judging. A subset, about half of this group, will then go to a second round interview. There'll be another round of judging at the second interview stage. And then a subset, so basically top 1% will then be invited to enter into the accelerator program, and then there'll be a negotiation about what investment terms that the VC investor and the startup will, under which you will participate. And so one of the first things that we can see by just looking at this VC judging data is there seems to be a high emphasis on group decision making. So for example, in the pre-interview round, the average or median number of judges judging the exact same company is about 9 judges. So it seems to imply that VC investors place a lot of value on having multiple sets of eyes looking at the exact same application and trying to derive some sort of consensus view. Now, what's kind of interesting when we delve into the data a little bit more is that even when assessing the exact same startup applicant and having access to the exact same information about that company, there is still a high amount of disagreement between individual judges about what's this particular startup's potential. And so to try and sort of put this in concrete economic terms, if our sample VC accelerator relied solely on the lowest or the bottom pre-interview score for its eventually accepted startup applicants. And so just sort of getting back to the point here. So if we kind of relied solely on the lowest or the bottom judging score for the eventually accepted applicants into this accelerator program, over half of these eventually accepted cohort firms may not have even made it to the first round interview stage. And so there definitely is a lot of disagreement between individual judges about evaluating the same startup. And we think that as a first or important question, we should understand why that is. And the reason we think that's important is there's a lot of studies that have been growing in the economics and finance literature that has relied on variation in consensus scores to run like regression discontinuity designs to look at various outcome variables. But what we want to do is try and take a step back and ask the initial question, well, why is this variation in this first place? How do we get that we have a lot of very smart people in the room evaluating the same company can get to very different conclusions? And so what we're going to look at then is, well, what could be the potential drivers of this individual VC judge score variation? And so the first one that you could potentially look at was, what about startup firm characteristics? Maybe there are certain characteristics that correlate with having more variability. Now the problem is that these startup firm level characteristics cannot explain why there is significant variation in judging scores for the exact same company. So it cannot explain within firm judging variation. So there must be some other sources. And so some other potential sources are judge level characteristics, as you mentioned. Could be professional experience, could be educational background. It could be that I just always give people 50 because I judge hard. And so that's another possibility. But another sort of third, what we think is an intriguing possibility that could be affecting individual VC judge score evaluation is the presence of any affinity-based characteristics between individual VC judges and the firm founders that they're evaluating. And what I mean by that, when we talk about affinity, is that maybe I judge companies differently if I have shared gender with them, or I went to the same university as that person, or I worked at the same employer as that person, et cetera, et cetera. And so while there's evidence of homophily in other business-related contexts, so for example, and where homophily is defined as the tendency of individuals to want to work with others who have similar personal or social characteristics as ourselves, there's evidence of that in other business-related contexts like formation of venture capital syndicates, and there's also some mixed evidence about discrimination against certain types of entrepreneurs. What we don't think there's ever been a study which has tried to directly examine whether these judge-founder affinity biases may exist and how significant they may be. Okay, so to sort of talk a little bit about what's the empirical specification that we're going to use to try to tease out what's the relative importance of startup characteristics, judge characteristics, and these potential judge-founder affinity biases and affecting individual judging evaluation. So our dependent variable here is the judge score for company I applying to cohort C, where the judge score is given by individual judge or VC employee judge J. And so in terms of our main independent variables, first we have sort of these judge-founder affinity-based characteristics based on shared gender. So do the judge and the firm founder have the same gender? Shared education, so did the judge and the founder attend the same university? And shared employer, so did the judge and the founder worked at the same employer? And then we've got additional sort of control variables related to startup characteristics and individual judge characteristics. Because of the fixed effects specification that we're running, is that if we're evaluating the same startup firm, and so I guess I'll jump through with the results, why should it be that if 10 VC judges are evaluating the exact same firm, why should some judges who have a shared gender give a higher score for the exact same firm? Because they have the same information set for that company, but one is just giving it higher, just related to these affinities. So you're right, there's a lot of other things going on, but as I sort of explained on this slide, because of the multi-layered fixed effects specification we have, that should absorb a lot of this other potential outside variation other than these affinity biases. So for example, with the firm fixed effects, what we can do here is we can really identify how the differences is individual judge characteristics and these potential judge founder affinity biases affect the evaluation of the exact same firm. So you have the same information set, but you give a different score. But then with that, we also have judge fixed effects. So we can see how the same individual judge evaluates different startup applicants with different startup qualities, as well as if they have an affinity bias with these different startups or not. And so we can keep the exact same judge fixed and compare how they score differently across startups. And then finally, we have cohort fixed effects, so we can deal with any time trends at either the macro or the micro level that might affect individual judge score variations, or evaluation, sorry. Yes, question?
Can you evaluate which judges are better judges?
Yeah, that's actually a really good question. So we could delve into a little bit with some of these judge characteristics in terms of experience. I don't remember, we can actually do that separately, because I guess within the same specification, it should be all else being equal, what, for example, is experienced. Are more experienced judges less likely to have any of these biases? And we could do an interaction effect as well, I guess.
The other thing you could do is, are some judges better at some types of firms? Like, you know, if I've been in this industry, am I better at judging whether or not a startup is likely to be successful? Or if I have a similar PhD versus MBA background as the founders, am I more likely to be successful at evaluating a startup?
Exactly. So that was sort of the question sort of earlier is like, is there industry experience, for example, it could be driving it. So 100%, that's possible too. So we've tried to sort of capture that with these startup and judge characteristics, but we could always add more and also think about interactions as well. So that's a good suggestion. Okay, so it's kind of, talk about, run this specification. What we have is sort of what we think is two sort of interesting findings. So the first thing is that these judge sort of founder affinity biases do seem to be present and are important. So each of these sort of shared gender, shared education, shared employer, the way to sort of interpret this is that for the same startup applicant, if one of the judges has shared gender or shared education or shared employer, they might give like a 5-point higher score relative to another judge evaluating the same company that doesn't have this potential affinity bias. And so you can imagine that for the marginal firm, this could be quite important as to whether they progress through the next stage of the accelerator application process or not. Yeah.
Startup firm characteristics include everything that might be part of shared education and shared employer, right?
Yes, that's right.
Stanford and MBA-led firms are really great. We control for that. It just happens that if you get a Stanford MBA evaluator, you're even more likely to get to the next round. Correct.
So like startup firm characteristics is like, what percentage went to a top tier school? So is it like there's something about the quality of your...
Right, what is shared education?
So you just attend the same university.
Right.
So simply,
But if there's differences in the university, like let's say Stanford is really good, just for the sake of argument, then it could be that what you're capturing is the VCs hire Stanford grads, the best startups have Stanford grads, and that's what's driving the shared education. Like it seems like everything that you put in shared education and shared employer has to show up in startup firm characteristics for us to be able to interpret these.
Yes, absolutely. So, and they do. So like startup firm, it's like, it's not like I have an individual for Stanford, it's for top tier. Like if you go to Harvard
what does shared education have?
So that's simply, do you have the same university? It doesn't have to be top tier at all. It can be just like, I went to,
is that if there are differences in whatever your top tier is or whatever your middle tier is, that could be driving why shared education shows up in a way that's not really about shared education. It's about that we really think Stanford and Stanford grads alone are awesome. And we've hired a bunch of Stanford grads.
Right, so that's a fair question. So I guess that then comes down to how you define top tier. So we've tried to follow the literature in terms of how do you define top tier in terms of Stanford, Harvard, but we could always play around with that if there's something, in terms of how you define top tier, I guess. But we're not seeing it's not just confined to like, well, we're both sort of at a top tier university. It's happening we just happen to attend the same university wherever, so it's I don't think that can be driving this because we do control for it here. So you have to imagine that like somehow how we're defining top tier university is kind of way off the reservation. so to speak, to get to your story.
That off the road. I guess it's an empirical question, but I guess I'm not convinced it has to be that far off the reservation to sort of drive these shared education, shared employer results. Like all I have to believe is that the VC has beliefs about which schools are best within tier, and they tend to hire from those places, and then they fund those firms.
Yeah, no, for sure. So I think it's fair. So that's why we kind of try to control for any sort of top tier type effects. We could argue about,
I think you have to do it at the school and employer level.
Okay, so I guess I have to see, obviously be a very long regret because if there's a Stanford effect, I guess we could do it. I guess we do have a lot of applications and judges, so potentially, yeah. And then the second thing that we briefly try to do is that we sort of look, was there any evidence of outright discrimination? So for example, if you just get in the second column, we add a dummy variable for whether the startup has an all-female founding team and runs sort of the same regression. What we find is that there doesn't seem to be evidence of just lower scores being given to all-female founding teams. It seems to be that these more subtle judge firm founder affinity biases are the more prevalent issue in individual sort of VC judge evaluation. Okay, so in the interest of time, I'll skip over the sort of heterogeneity test. So where is this most prevalent? But I'll just give you the headline that essentially we find that this effect seems to be much stronger for so-called pre-revenue startups, where there's less fundamental information about the revenue generation potential of the business, customers, margin potential, etc. And so what we think it indicates is that these types of biases are more likely to manifest themselves where there's more subjectivity in the environment about how to evaluate startup potential, versus if you have a company that has existing revenues, customer base, there are some more fundamental information, in inverted commas, to be able to rely on. And we don't seem to see these biases really driving things in those scenarios. Okay. So the second sort of research question we want to sort of address is thinking about, well, assuming that companies get through the application process, well, how does early stage VC investors contract with startup firms in terms of financial investment terms? And so until recently, convertible notes were sort of the most common contracting instrument for seed financing rounds. So these convertible notes are a mix of both debt, so they have an interest rate, a specified maturity after which you can demand repayment, but also equity. So there's a right to convert to equity in the startup at some future point in time. And so this has been supported by a lot of sort of theory models, and they're very popular because the argument is that the investor can retain equity upside in the startup without having to specify a specific price for the startup today with a direct equity purchase. Okay, so what we think is interesting though is that we think we've provided some of the first empirical evidence that convertible notes appear to be increasingly replaced by a new innovation in financial contracting among startups known as deferred equity agreements. And so these deferred equity agreements started with Y Combinator in 2013, known as a simple agreement for future equity, or SAFE, followed a year later by Keep It Simple securities developed by 500 startups. And so, according to, obviously getting done, and this is very difficult, but according to AngelList, it's estimated that these SAFE and KISS contracts comprise up to 80% or more of new seed financing rounds. But we're often, researchers and also practitioners are operating in somewhat of an empirical black hole because we have no information about how these financing contracts are actually being used in practice. And so before I get to the data that we're going to examine, let me very briefly try and give you some intuition for how these KISS and SAFE contracts work. And so the way that these contracts work is that at time zero, so today, the investor will provide the financing to the startup, but will not receive any shares in the company at that point in time, nor will a specific price be set for those shares. Then at some later point in time, so time one, so say 1 or 2 years later, hopefully the startup will then raise another financing round where someone else will then pay a specific price for the equity, and therefore the SAFE and the KISS investor will receive some shares in the startup based on the price paid in this next financing round. And so the key sort of, I don't want to get in all the weeds of how these contracts work, but there's sort of two key things to realise with safe and KISS contracts. The first is there's no debt obligations associated with these deferred equity agreements. So there's no interest charges, no sort of specified maturity date. And then the second thing is that the number of shares that the safe or KISS investor will receive is going to be based on the investment amount divided by the so-called conversion price, where the conversion price is going to be defined as the lower of the discount price. So it's the next round's price times by 1 minus the discount rate, where I can tell you that it's just standard that it's 20% in these contracts. And then there's also this capped price, which represents the maximum price that the the safe or KISS investor will pay for the shares that they receive in the startup firm. And so that's defined as the valuation cap in millions of dollars divided by the fully diluted share capitalisation of the startup firm. And so there's sort of been many reasons given for the growing popularity of these safe and KISS contracts, but the key sort of reason given by practitioners is that because these are standard form contracts that you can literally download off the shelf from Y Combinator or 500 startups, it greatly reduces the negotiating cost and time of being able to sign these agreements. Because the practice is that there's only one contract term that startups and VC investors negotiate over, which is this valuation cap. So this will set what is the maximum price that the early stage investor will pay for shares in this company. And so what you can see is that there's actually a tension here between the entrepreneur who will want that valuation cap to be as high as possible, because if they raise money at a very high price, you don't want this cap price to bind and effectively the investor buys at a lower price, versus the investor wants these valuation caps, all else being equal, as low as possible, because it reduces the maximum price they pay and will thus give them more shares in the startup. So there's this tension here between these two parties.
Why don't they argue about the discount rate? It seems like for reasonably high valuation caps, they're never going to bind anyway. So maybe we don't care as much. With the discount rate, that always affects the divvying surplus. Yeah,
no, it's a great question. So this was kind of this is what would happen with convertible notes, where all the terms would be up for negotiation. And people would have to go, well, what's the discount rate? What's the value? If there's a valuation cap, if there is one, what's the value? What are all these other terms? And that's what resulted in all this time and cost negotiation. And so what we're seeing now is that startups and VC investors are moving away from that type of detailed negotiation towards these standard firm contracts where there's only one term to negotiate. So you could do that, and that would be the convertible note model. What we're observing is that a lot of companies are going to this deferred equity agreement setup where there's only one negotiator.
Valuation cap.
Yes.
It might be a good investment even with the valuation cap was in there.
Right, absolutely. So that's up for negotiation between the parties, but it's trying to do one dimension. So obviously what's sort of hampered empirical work in this area has been a lack of data. And so we're very fortunate that we've been given access to all the financial contracts that have been signed by the startups that entered this sample accelerator program. So we've got 120 deferred equity agreements, comprising 104 KISS contracts and 16 SAFE contracts across 10 different cohorts. So what you can see is that all of the financial contracts were these new deferred equity agreements, and also all these KISS and SAFE contracts have valuation caps. And so in our sample, the average investment or median investment's 150,000. The median valuation cap is 3.5 million. Now, what's really interesting is that in the due diligence phase, each of the startups is asked a question, what is the current valuation of your firm? And so when we tracked all these answers, for the eventually accepted firms, you can see that the startup firm's current valuation is a really important anchor or reference point for setting these valuation caps. So it sort of implies that these caps are set fairly low. It doesn't take much growth in the value of the startup to basically hit this cap for the price to actually bind. And so sort of gets this question, well, how are these rounds really unpriced or not? So in the interest of time, so basically what we try and do in an empirical spec is that we look at these valuation caps, which is the only sort of negotiating item for the VC investor in the startup firm. We then look at startup firm current valuation, where based on the summary statistics, it looks like it's a very important anchor or reference point. Then we also look at judging scores. So I won't go into the details of how would you derive this in a double moral hazard model, but the basic sort of prediction here is that for firms that have higher judging scores, that correlates to higher internal VC assessment of startup quality, which then predicts higher valuation caps for these firms. Now, sort of the last variable that we think is kind of interesting to investigate is thinking about, well, how important are financial constraints in affecting the bargaining power of startup firms and thus the attractiveness of the investment contract terms that they receive. And so while it's fairly intuitive to believe that firms that are more financially constrained will achieve worse financing terms, trying to measure this empirically is really difficult because trying to get a direct measure of financial constraints, especially for private firms, is extremely difficult. Now, what's kind of nice about our setting is that, again, one of the due diligence questions that these companies are asked is how much runway do you have, or how many months can you continue operating the business in its current form before you exhaust your cash reserves? And therefore, if you don't raise money, you'll go bankrupt. And so we think that this is a nice direct measure of the financial constraints faced by startups. And so the basic prediction is that increased company runway relates to less financial constraints, and therefore these firms can negotiate better valuation caps. Okay. So skipping forward through to the results, obviously we find that the startup firm's current valuation is really important in setting these valuation caps. So there's this real anchoring on this figure. Also, firms that receive higher judging scores from the internal VC also attain higher valuation caps. And the other thing that's important about our setting is that because we can have a separate measure of the quality of the startup, so we have the VC's own assessment of how good the firm is, we can kind of cleanly estimate, well, what really is the effect of financial constraints by comparing firms that have similar VC internal quality scores, but one is financially constrained and one is not. And what we see is that for firms that have less sort of runway or are more financially constrained, they receive significantly worse valuation cap offers. And so to kind of put this in economic terms, for each 1 month decrease in the runway that a firm has, that results in a 2% reduction in their valuation cap, which is quite a significant cost that financially constrained firms can bear for being financially constrained. Basically to sort of conclude, we use a sort of novel accelerator dataset to try and open the black box of VC portfolio firm selection and VC style contracting. We find sort of this very interesting heterogeneity in individual VC judging scores. We try to unpack what those sources may be, and also note that there's this real development of new financial contracting instruments, those deferred equity agreements, that seem to have really changed the startup funding market and deserve some further investigation. So happy to answer any questions that people have, but that's everything that I had prepared. And apologies about the technical issues at the start. Cool. Thanks.